speaking of denim, VF Corp spun off its jeans business, Lee and Wrangler, as Kontoor Brands. It was considered to be a total dud initially. For months, I've been telling you that VF desperately needed to spin off its ailing denim division for its stock to go higher, which it is, by the way. But once Kontoor started trading, I realized it had a lot going for it, including a bountiful dividend that currently yields 5.6%. That's why I recommended this thing in July, and then since then, it's up 37%. Obviously, Kontoor is much less of a slam dunk after this move. But the dividend remains attractive, and it is still fairly cheap. It only sells for 10.6 times this year's earnings. I say stick with it, but remember, apparel seems to go up or down depending on Chinese trade talks and what you're hearing from, let's say, Gap stores to Nordstrom to Kohl's. Next, how about the ride-sharing stocks? Now we're dealing with Lyft and Uber. Lyft was the first huge IPO of the year, and it was a disaster right out of the gate, with the stock opening up at 87 and change before going to plunge to 78 at the close on its first day of trading. You know, it almost opened at 100. That would have been really bad. And it kept getting slammed over the summer as the market fell out of love with unprofitable but fast-growing companies. By mid-October, it had fallen to 37. But then we started hearing that both Lyft and Uber were committed to reaching profitability sooner than previously planned, certainly sooner than they would when they were on the roadshow. And that's why I recommended Lyft in November. They seem to be getting their act together, and the market had already digested a wave of new shares from the lockup expiration. And since then, it's rallied nearly 8%. I think the fundamentals here remain intact until something goes wrong or the stock goes substantially higher. We're going to stick with Lyft. It doesn't hurt that we're starting to see second and third rate ride-sharing companies go under, like Juno, which just referred all of its customers to Lyft. With the stock trading at roughly 3 times sales, I know you want it by earnings, but it's for sales. I think the valuation is actually pretty reasonable. Lyft delivered 63% revenue growth in the most recent quarter. That's pretty terrific. Then there's Uber, Lyft's larger, more troubled cousin. When I recommended Lyft last month, I told you to wait on Uber because the lockup on insider sales was about to expire. I figured that could really slam the stock price. Since then, there's been a wave of bad news. Former CEO Travis Kalanick has sold more than $2 billion worth of stock since the lockup expired. When I met Travis at the White House Correspondents' Dinner, the first thing he said was he was much richer than I am, which I felt smacked of hubris. There was a horrific safety report. Local governments all over the world are trying to crack down on the labor practices. They just got banned in Germany. I mean, tons, right? But you know what I got to say? Uber, the stock, has done an incredible job of hanging in there, especially the last few weeks. Consider that it did it under the onslaught of a man who's much richer than I am, Kalanick, dumping all that stock. Plus, I like that they're selling the ailing Uber Eats India business. I wish they sell the whole darn thing. If they were to simply close the unprofitable Uber Eats, the stock could soar. I still prefer Lyft, but I suspect Uber may have bottomed here, especially if they bite the Uber Eats bullet.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.